It's day 3 of the Ikea effect. If you're just tuning in, the Ikea effect is when you value something more because you put effort into it. Like, for example, if you go to Ikea and you buy a table that you would have bought somewhere else for exactly the same price, only at Ikea you have to put the thing together yourself. And that makes you feel like, wow, this is a really great table. When if you had just bought the exact same table from somewhere else, you probably wouldn't have cared that much. Anyway, so for today, I wasn't sure exactly what to do, so I looked through some of the other science journals and publications, and I found this article, which seemed like it might be interesting. Nudging Against Panic Selling. So this article is talking about investors in the stock market. A typical behavior pattern of investors is to, like if the market is crashing, to sell, right? Because everybody else is selling. So if everyone else is selling, you also sell because you get scared. So you always hear everybody say buy low, sell high, right? But the way we're wired fundamentally is like when things are going a little crazy, we tend to like panic and do things we probably shouldn't do, especially in investing. So this leads to a buy high, sell low strategy. That is, as you can imagine, probably not the best for long-term wealth accumulation. So what they're suggesting is a nudge based on the IKEA effect and the endowment effect. So they're kind of combining the two. That will kind of hedge against this like panic selling. So what they did in this study was they actively involved the investors in the selection process of risky investments to give them a what felt like a self-assembled portfolio. So they're using your university students for this experiment, 219 of them, and they're claiming that this nudge makes a difference that is at least as big as the difference between experienced and inexperienced investors, which I feel like is quite the claim. Anyways, let's get into it. So this panic selling is like a well-known thing in the stock market. People are scared, people are worried they're going to lose their money, so they sell. But there isn't really like a practical method like preventing this. It's kind of just like tell people and hope they listen. Most solutions are based on like portfolio diversification and long horizon investments. So like get as many different stocks as you can to hedge against crashing, and also have your ultimate goal be the long game, right? So those are the main ways that people kind of like hedge against crashes or losing their money in the stock market. But if you can find a way to make people feel like that money is their own, or like they put it together themselves, it might help a little bit. And this is a better definition of the endowment effect than I gave yesterday. People often demand much more to give up an object than they would be willing to pay to acquire it, right? So if I had like my favorite pen or something, I would probably ask you to pay me a lot more than I actually paid for the pen in the first place just because it's mine. So kind of the main point of this study is if you can get people to feel like they own something, or they have possession of something, or they like worked, they put actual time and effort into making it up, then you can get them to keep it and not just throw it out the window at the first sign of trouble, or make it less likely. All right, so this paper was just a snippet. It wasn't the full paper, so I went here for the actual article. Also, if anybody's out there and needs like publications for free or any books or anything, Anna's archive is the business. Hot tip. So the way this study worked is they played an asset allocation game, which consisted of 3 different parts. So in the first part, they asked the participants to put their money into assets that they thought were risky and risk-free. They were asked the following question. Imagine that you have won 10,000 euros in a lottery. You want to invest this amount in a portfolio with long-term investment strategy of 30 years. And then they're kind of asked to put their 10,000 euros into different equities. And then in the second part, they divided the participants into 2 groups. And group 1, they're the non-advised group. So this group is not being helped. No one is kind of advising them on how to spend their money. And then they let them choose their own portfolios. They're kind of advising them that they should be basing their decisions on the long-term basis of 30 years. And they're kind of picking different regions throughout the world to invest in. And then group 2, which is the advised group. So this is the group where the people are kind of helping them out to pick. They did not let them choose their own regional portfolio. They were asked to do the following. They imagined they got the 10,000 euros, but then they contacted the bank advisor and had the bank put a stock portfolio for them together. And then they were the ones who invested exactly according to the recommendations of the bank. And then they asked the questionnaire. They had a questionnaire to like kind of gauge who they were as a person, kind of, and like figure out what is this person likely to do in a normal situation. And then they also had this part, which I didn't really understand. I kind of just skimmed this. I was more interested in the result. So in total, there was only 219 people that took part in this experiment, which I feel like is a fair amount. 56% were male, 85% were between 20 and 30, and overall 95 were included in the non-advised group and 124 in the advised group. I don't understand why it wasn't a 50-50 split. Why was there such a larger number in the non-advised group, which I feel like is a little strange. So after the market crash, after the simulated market crash, the investors who chose their own portfolios. So it kind of goes into detail about like which ones, like the male investors versus how the male investors responded versus female investors versus business majors, how they all responded differently. But then statistically, it gives a kind of general answer. Statistically significant differences in the proportion of stock sellers between non-advised and advised groups. And they conclude that as compared to other variables, the effect of our nudge is strong. The nudge is strong with this one. So then they say this again, it is of a similar or even larger magnitude than the difference between an inexperienced and an experienced investor. It even has a stronger effect than behavioral preferences that might contribute to panic selling, which is kind of crazy, which is a bold, strong statement to make. I feel like, especially if you only did it on 219 people, I feel like that's not a large enough sample size to make that claim, but what do I know? So in conclusion, they basically felt like their hypotheses were confirmed. Like the nudge, the IKEA effect does work to kind of hedge against panic selling during a crash, but they also kind of mentioned too much, like over attachment might do more harm than good, because people might assemble a portfolio they like, stick to it, even though that portfolio is actually bad or is not going to turn out well in the long run. It might kind of contribute to inspiring someone to hold on to a investment longer than they should. They point out that they only use students, they didn't actually use investors. These are some limitations. Also, they only analyzed hypothetical investment decisions. They weren't actually investing in real world stocks or investments. They did say something interesting though. The results suggest that the involvement of investors in the selection of assets can have surprisingly beneficial effects even if the investors do not possess good asset selection abilities. Kind of like if you assemble your own portfolio, even if you're bad at picking stocks, you're more likely to do well in situations where other people would sell them off too early, which is kind of makes me feel like, maybe I should look into investing. I don't really have to be that good at it. I just have to like wait through the crash. Anyways, I wanted to look into some other stuff about this, but I ran out of time, and that was all the time I had for. And that was the end of my notes. So thanks for hanging out. Catch you in the next one. Peace.